Have you ever heard of traders making hundreds of millions of VND, or tens of thousands of dollars, in a single day? It sounds like a dream, right? Well, for some, it's a reality, and one of the powerful techniques they use is called multi-timeframe analysis. Today, we're going to demystify this strategy and show you how you can apply its principles to your own trading. So, grab a coffee, get comfortable, and let's dive into the world of multi-timeframe trading. First things first, what exactly is it? In simple terms, multi-timeframe analysis means looking at the same financial instrument, like a stock or a currency pair, across different time charts. For example, you might look at the daily chart, the 4-hour chart, and the 15-minute chart all at once. Why would you do this? Think of it like using Google Maps. The daily chart is your satellite view. It shows you the big picture, the major trend. Are we in a long-term uptrend, downtrend, or just moving sideways? This is crucial because trading against the main trend is like trying to swim against a strong current. It's much harder and riskier. Once you've identified the main trend on the higher time frame, you zoom in. This is where the intermediate chart, like the 4-hour or 1-hour chart, comes in. This is your city view. It helps you identify more specific patterns, pullbacks, and key support and resistance levels within that larger trend. For example, if the daily chart shows a strong uptrend, the 4-hour chart might show a temporary dip or a consolidation phase. This dip isn't a sign to panic and sell. It's a potential buying opportunity. You're looking for a chance to get into the market at a better price, in alignment with the bigger trend. Finally, we zoom in even further to the lower time frame, like the 15-minute or 5-minute chart. This is your street-level view. This chart is for execution. It helps you pinpoint the exact moment to enter or exit a trade. You've already established the overall direction from the higher time frames. Now, you're just waiting for the perfect trigger. This could be a specific candlestick pattern, a break of a small trend line, or a signal from an indicator that tells you, okay, the pullback is likely over, and the price is ready to resume the main trend. It's time to act. By using this lower time frame, you can make your entries much more precise, which helps in setting a tighter stop loss and improving your risk-to-reward ratio. So, let's put it all together with a classic example. Imagine you're looking at the EUR/USD currency pair. You start with the daily chart and notice a clear, strong uptrend. The price is consistently making higher highs and higher lows. Your bias is now bullish. You only want to look for buying opportunities. You then switch to the 4-hour chart. You see that within this big uptrend, the price has pulled back to a key support level that was previously a resistance level. This is a classic support-resistance flip, a very strong signal. The market is showing respect for this level. Your interest is piqued. This looks like a great area to enter a long position, but you don't just jump in blindly. Now you zoom into the 15-minute chart for the final confirmation. On this chart, you wait for the price to show signs of turning back up. Maybe you see a bullish engulfing candle form right at that support level, or perhaps the price breaks above a small downward trend line that formed during the pullback. Once you see that trigger, that's your signal to enter the trade. You place your buy order. Set your stop loss just below the support level to protect your capital, and set your take profit target based on the potential of the larger trend. You've just used 3 different time frames to build a high probability trading setup, from top to bottom. This top-down approach is what gives traders a massive edge. It aligns your short-term actions with the long-term market flow. It prevents you from getting caught on the wrong side of a major move. A trader who only looks at a 5-minute chart might see a small downtrend and try to short it, only to get run over when the larger uptrend resumes with force. By using multi-timeframe analysis, you gain context and perspective. You understand the difference between a minor ripple and a major tide. Of course, this strategy requires discipline and patience. You can't force a trade. Sometimes the signals on different time frames won't align. The daily chart might be bullish, but the 4-hour chart might be showing signs of a deeper correction or even a reversal. In those cases, the best trade is no trade. A professional trader knows that protecting capital is the #1 priority. You wait for the stars to align for all your time frames to tell you the same story. This synchronization is where the highest probability setups are found. So, how can you start implementing this? First, choose your 3 time frames. A common rule of thumb is to use a ratio of 1:4 or 1:6. For example, if your main chart is the 1-hour chart, your higher time frame could be the 4-hour chart, and your lower time frame could be the 15-minute chart. If you're a long-term swing trader, you might use the weekly, daily, and 4-hour charts. If you're a day trader, you might use the 1-hour, 15-minute, and 1-minute charts. Find the combination that fits your trading style and personality. Next, practice. Open your charting platform and start analyzing. Pick a stock or currency you like and go through the process. Identify the trend on the highest time frame. Look for key levels and patterns on the middle time frame, and then search for entry triggers on the lowest time frame. Do this over and over again on historical data. This is called backtesting. See how it would have performed in the past. This builds your confidence and helps you internalize the process, so it becomes second nature during live trading. Remember, multi-time-frame analysis in a magic bullet that guarantees every trade will be a winner. Trading always involves risk, but it is an incredibly powerful framework that can dramatically improve your decision-making process. It brings structure, clarity, and a higher level of probability to your trading. It's a cornerstone of what separates consistently profitable traders from the rest. It's about combining the big picture with the fine details to execute with precision. So, the next time you hear about those incredible daily profits, remember that behind them is often a disciplined, methodical approach like multi-time frame analysis. It's not about gambling. It's about stacking the odds in your favor. Start incorporating it into your routine. Be patient, and watch how it transforms your perspective on the markets. Thank you so much for watching. I hope this breakdown was helpful and gave you a clear understanding of this professional trading technique. If you found value in this video, please hit that like button, and don't forget to subscribe and turn on notifications so you won't miss our next deep dive into the world of trading. Let me know in the comments which time frames you like to use. Until next time, trade smart and trade safe.